There is a famous saying, often attributed to Mark Twain, that goes, "History does unrepeat itself, but it often rhymes." If you want to understand what is about to happen to your money in 2026, you should not be looking at the stock market ticker today. You should be looking at Germany in 1923, or Britain in 1944, or the United States in 1971. Because what we are witnessing right now is not just a recession. It is not just a market correction. We are witnessing the end of a long-term economic supercycle. For the last 40 years, since the early 1980s, we have lived in a very specific type of world. A world where interest rates generally went down. A world where globalization made everything cheaper. And a world where paper wealth, stocks, bonds, and currency was king. But that world is ending, and a new world is being born. The rules of this new world are completely different. In this new cycle, interest rates stay high, supply chains break down, and the only things that hold value are hard assets, things you can touch, hold, and use. Most people are completely unprepared for this shift. They are holding portfolios designed for the last 40 years. Not the next 10, but the smart money has already figured this out. While the average investor is chasing the latest tech stock hype, the biggest players on the geopolitical stage are quietly heading for the exit. China is moving trillions of dollars out of Western paper currency and into physical resources. Central banks are buying gold at a pace we haven't seen in 55 years. They know something that you are not hearing on the evening news. They know that the era of unlimited debt is hitting a mathematical wall. And when that wall is hit, the great asset reset begins. In this video, I'm going to take you on a journey through history and economics to show you exactly why this shift is inevitable. I will explain why the paper wealth you think you have might be an illusion. I will show you why commodities, land, and precious metals are set to rule the next decade. And I will give you a strategic roadmap to position yourself on the right side of this massive wealth transfer. Because in a reset, wealth is never destroyed. It is merely transferred. The only question is, will it be transferred away from you or towards you? The death of paper wealth. To understand why paper wealth is dying, we have to talk about debt. But not just credit card debt or mortgage debt. We need to talk about the sovereign debt cycle. Every major empire in history follows a predictable pattern. They start with good money and strong production. They become rich and powerful. Then, they start borrowing to fund wars or social programs. Eventually, the debt becomes so large that it can never be paid back in real terms. The United States is currently at the end of this cycle. We have over $34 trillion in federal debt. The interest payments on that debt are now higher than our entire defense budget. Mathematically, there are only two ways out of this trap. Option 1. The government defaults. They simply tell bondholders, "Sorry, we are not paying you back." This causes a catastrophic depression, so no politician will ever choose it. That leaves option 2. Inflation. They print new money to pay off old debts. They pay you back in dollars that are worth significantly less than the ones you lent them. This is called financial repression. It is a fancy term for a stealth tax on your savings. And this is exactly why paper assets like long-term government bonds are becoming certificates of confiscation. If inflation is running at 5% and your bond pays 4%, you are guaranteeing a loss of purchasing power every single year. Now, let's look at China's role in this. Beijing understands this cycle better than anyone. They hold nearly $1 trillion of U.S. debt. They know that the purchasing power of those dollars is going to be inflated away. So, they are executing a strategic exit. This is the real story behind the headlines you see about trade tensions. It is not just about tariffs. It is about China saying, "We do not want your IOUs anymore. We want real stuff." This is why they are dumping U.S. treasuries and buying gold. This is why they are buying copper mines in Africa and oil fields in the Middle East. They are trading paper, promises for physical reality. And they are doing it while prices are still relatively cheap. There is another massive signal that the era of easy paper money is over. The unwinding of the yen carry trade. For decades, Japan acted as the world's ATM. Investors could borrow Japanese yen for almost zero interest, swap it for dollars, and buy American stocks. It was free money, and it inflated asset prices across the globe. But now, with inflation rising in Japan, the Bank of Japan is forced to raise interest rates. The ATM is closing. The liquidity that pumped up the stock market bubble is being drained away. This is a structural shift, not a temporary blip. It means that the valuation of paper asset stocks and bonds has to come down to match reality. The price-earnings ratios that made sense when money was free do not make sense when money costs 5% or 6%. We are watching the slow-motion deflation of a 40-year asset bubble. And if your entire net worth is tied up in that bubble, you are in a very precarious position. The rise of hard assets. So, if paper assets are dying, what takes their place? History gives us a very clear answer. When faith in fiat currency declines, capital flees to hard assets. A hard asset is something that cannot be printed by a central bank. It has intrinsic value. It has utility. 'Tis finite. We are talking about energy. Oil, natural gas, uranium. We are talking about industrial metals. Copper, nickel, silver. We are talking about agricultural land, the soil that produces food. And of course, we are talking about monetary metals. Gold. Let's look at the gold 2s and P500 ratio. This is a chart that tracks how many ounces of gold it takes to buy the S&P 500 index. At the peak of the dot-com bubble in 2000, stocks were incredibly expensive relative to gold. At the bottom of the cycle in 1980, stocks were incredibly cheap relative to gold. Right now, we are closer to the 2000 peak than the 1980 bottom. This suggests that over the next decade, gold is going to massively outperform the stock market. It is simply a reversion to the mean. But it is not just about gold. Let's talk about energy. Modern society is completely addicted to cheap energy. Data centers, electric vehicles, crypto mining, they all consume massive amounts of power. But for the last decade, we have underinvested in energy production because of ESG mandates and low prices. We have a structural shortage of energy. Owning the companies that produce oil, gas, or uranium is owning the lifeblood of the future economy. Then there is copper. You cannot have a green revolution without copper. Wind turbines, solar panels, and EV grids require huge amounts of it. Yet, we are not discovering new copper mines fast enough to meet demand. The physics of supply and demand guarantees that the price of copper must rise. And then there is land. As Mark Twain also said, buy land. They're not making it anymore. In a world of debased currency, productive farmland is the ultimate defensive asset. It generates income. It feeds people, and it cannot be inflated away. This is why you see billionaires like Bill Gates buying up hundreds of thousands of acres of farmland. They are not doing it because they like tractors. They are doing it because they understand the great asset reset. They are moving their capital from the digital world to the physical world. The transition from a financial economy back to a real economy is the defining theme of the 2020s. In the financial economy, the heroes are hedge fund managers and software engineers. In the real economy, the heroes are geologists, farmers, and miners. The valuation gap between these two worlds is at a historic extreme, and it is about to snap back. Scenario 2026 to 2030. Let's project this forward. What does the world look like in 2026, 2028, and 2030? We are entering an era of secular stagflation. This means economic growth will be slow and choppy, while inflation remains stubbornly high. Governments will engage in financial repression to manage their debt loads. They will keep interest rates below the real rate of inflation. If inflation is 5%, they might keep rates at 4%. This means cash savers will be slowly bled dry. It is the only way the government can stay solvent without defaulting. In this environment, holding cash is a guaranteed losing strategy. But holding the S&P 500 is also risky because margins will be squeezed by rising input costs. The companies that will thrive are the ones with pricing power. And who has pricing power in a resource-constrained world? The companies that own the resources. If you own the copper mine and copper is in shortage, you can raise prices. If you own the oil, well, you can raise prices. This is the revenge of the old economy. We are going to see a rotation where capital flows out of overvalued tech stocks and into undervalued resource stocks. We are also going to see a return to national industrial policy. Countries will prioritize securing their own supply chains over free trade efficiency. This means more friction, more tariffs, more hoarding, and ultimately, higher prices for everything. For the investor, this creates volatility, but also opportunity. The passive investing strategy of just buying an index fund and forgetting about it will likely fail in this decade. You will need to be more active. You will need to be more selective. You will need to understand macroeconomics because the rising tide is no longer lifting all boats. Some boats are going to sink. Specifically, the boats that are heavy with debt and light on real assets. The boats that will float are the ones built of solid, tangible value. This scenario is not doom and gloom. It is simply a change of seasons. Winter is coming for the paper asset holder, but spring is coming for the hard asset holder. Strategy and conclusion. So, how do you position yourself for this great asset reset? I am not a financial advisor, and this is not financial advice. But I am a historian, and I can tell you what has worked in the past. The key is diversification, but not the diversification your broker talks about. They tell you to diversify between U.S. stocks and U.S. bonds. That is like diversifying between the Titanic and the iceberg. True diversification means diversifying across asset classes and jurisdictions. You need exposure to things that are outside the financial system. A sensible allocation for this new era might look very different from the traditional 60/40 portfolio. It might look like the permanent portfolio concept. Maybe 20% in gold and silver. This is your insurance against currency collapse. It is your chaos hedge. Maybe 20% in energy and commodities. This is your inflation hedge. When the cost of living goes up, these assets go up. Maybe 20% in real estate or farmland. This provides utility and yield, and the rest in high-quality, cash-flowing businesses that have low debt and strong pricing power. Notice that long-term government bonds are nowhere on this list. In a period of financial repression, lending money to the government for 30 years is a dangerous game. The most important thing is to change your mindset. Stop measuring your wealth in dollars. Start measuring your wealth in ounces, in acres, in barrels. Because the dollar is a measuring stick that is constantly shrinking. If your stock portfolio goes up by 10%, but the currency loses 10% of its purchasing power, have you actually made any money? No, you have just run in place. The Great Asset Reset is about preserving your purchasing power in real terms. It is about ensuring that 10 years from now, your labor and your savings can still buy the same amount of food, energy, and shelter. We are standing at a crossroads. One path leads to the continued illusion of paper wealth, which is becoming increasingly fragile. The other path leads to the solid ground of hard assets. It is a path that requires more effort to understand. It requires going against the herd. But history tells us that the herd is almost always wrong at major turning points. In 1999, the herd was buying Pets.com. In 2007, the herd was buying subprime mortgages. Today, the herd is buying the dip in a market that is fundamentally disconnected from economic reality. Don't follow the herd. Follow the smart money. Follow the central banks buying gold. Follow the nation's stockpiling resources. Position yourself where the puck is going, not where it has been. I want to leave you with one final thought. A question that serves as a litmus test for your readiness. If the stock market closed tomorrow and didn't open for 5 years, and if the dollar lost half its value in that same time, would your current portfolio survive? Would you still be able to feed your family and maintain your lifestyle? If the answer is no, then you have some work to do. But the good news is, there is still time. The window is closing, but it is not shut yet. Use this time wisely. Educate yourself, take action, and secure your future before the reset is complete. If you found this analysis valuable, and you want to dive deeper into specifically which hard assets are poised for the biggest gains, you need to watch my next video. I am going to break down the silver supercycle and explain why silver might be the most undervalued asset on the planet right now. It is the one metal that sits perfectly at the intersection of monetary demand and industrial shortage. Make sure you are subscribed so you don't miss it. History is moving fast. Don't get left behind. I'll see you in the next video.